All right, diving in today, we're tackling rental property financing. We've got a whole bunch of resources here.
It's a big topic.
Yeah, and it's not just like, getting a loan. This is about how financing can actually, make you money in real estate.
It's true. So many people, they just think of financing as, can I afford this? But it can really be a tool to build wealth.
So it's more than just affording it. It's about using it strategically.
Yeah.
Like, can you give us an example of how that might work?
Totally. So let's say there's a property and it's worth, say, $200,000.
Okay.
You could pay cash, the full $200,000, or you put down 20%.
So $40,000.
Right, $40,000, and you finance the rest. Now, let's say the property goes up in value, like 5% in a year.
Okay.
That's $10,000. If you paid in cash, you made 5% on your money.
Makes sense.
But if you financed, you made $10,000 on your $40,000.
So that's like, what, 25%?
Exactly, 25% return.
Okay, yeah. That's a huge difference. I'm seeing what you mean with the wealth building part.
Yeah.
But there's just like so many different loans. Where do people even start?
Well, probably the most common, most people know about conventional loans. It's what you get from most banks. A lot of people use them for their homes.
Right. But there's stuff specific to rental properties, right?
Yes, definitely. So with rentals, you're usually looking at higher down payments,
Okay.
like 15% to 25%. They see rentals as riskier than a primary residence.
Because they're worried about vacancies and stuff.
Exactly. So they really want to make sure you can handle the mortgage payments no matter what happens with the property. So they're going to check your credit score, your debt-to-income ratio, all of that.
Makes sense. So if you're just starting out, that 25%, that could be a lot of money. What if you don't have that much saved?
FHA loans can be great for new investors.
FHA.
Yeah, Federal Housing Administration. They insure the loans so lenders can be a bit more flexible. You can get a down payment as low as 3.5%.
Whoa. Okay. So you could start investing much sooner than you thought.
Exactly. But there's usually an owner occupancy requirement.
What does that mean?
You have to live in the property, usually for at least a year.
So like a duplex, you live in one side, rent the other.
Exactly. House hacking. It's pretty popular, especially when you're starting out. Now, for those who already have a few properties, portfolio loans can be good.
Portfolio loans, those sound fancy. What are those? How are they different?
So with a portfolio loan, the lender, they look at your whole real estate portfolio, not just this one property.
So it's about you as an investor, your track record.
Right. So they might be more flexible. Maybe your debt-to-income ratio is a bit higher, but they see you've got experience and your properties are doing well.
So they trust you more.
Pretty much. But usually the interest rates are a bit higher too.
So trade-offs. More flexibility, but maybe a bit more expensive.
Exactly. Now, have you heard of hard money loans?
Oh, yeah. Those are the ones they use on those house flipping shows.
Yes, those are for speed. Short-term loans don't focus so much on your credit.
Like if you need to close a deal fast and start renovating right away.
That's it. But they have much higher interest rates, often like double digits. And the repayment terms are really short, like a year or less. They're really for specific situations, quick turnaround.
Okay, so not for everyone. We've covered a lot. Conventional, FHA, portfolio, even hard money loans. What about something a little more out there?
There's what we call creative financing. Things like DSCR loans, seller financing, subject to lease options.
Okay, hold on. Let's take those one at a time. DSCR, what's that?
DSCR stands for debt service coverage ratio. Basically, they look at the property's cash flow, not your personal income.
Interesting. So like how much rent it could bring in.
Yeah. So even if you don't have a high income, but the property will generate good cash flow, this could work.
That makes sense. But are there downsides?
Well, usually higher down payments and interest rates than conventional loans, lenders see it as riskier.
Higher risk, higher reward. So many options. Now let's get really creative. What about seller financing?
So instead of a bank, the seller is the bank. They finance the property for you.
So you work it out directly with them.
Exactly. You might get a lower down payment, a flexible payment schedule, maybe even a lower interest rate.
Wow, cool. Okay, now subject to. That sounds complicated.
It can be.
Yeah.
You're basically taking over their mortgage payments, but the loan stays in the seller's name.
So you're stepping into their shoes, but legally, right?
Yes. It can be good if you have credit challenges,
Yeah.
but you definitely need a lawyer who knows what they're doing.
Makes sense.
Yeah.
Okay, last one. Lease options. Those are for people who can't get a mortgage yet, right?
They can be, but they also work for investment properties. You rent the property, but you have the option to buy it later.
So you can like live there, get a feel for it, and then buy it later.
Yes. And sometimes part of your rent goes toward the purchase price. It's like a try before you buy for investors.
Okay, we have covered so much, CH. It's amazing how many different options are out there.
And we're just getting started. What's really interesting is how each strategy can work for different people, different properties, different situations.
This is already so much to think about. It's clear financing is a really important part of this whole process.
For sure. And there's so much more to unpack when it comes to using these strategies to your advantage.
Definitely. We'll dive even deeper into that in the next part of our deep dive. Okay, so we're back, and I feel like we just scratched the surface of financing options.
Yeah, we threw a lot of terms out there.
We did. But now it's like, how do you actually use them?
Right. Like, how do you make these work for you? That's the key.
Totally. So let's talk strategy. Earlier we talked about leverage and how it can really boost your returns, but I think you also said it's a bit of a double-edged sword.
Definitely. It's powerful, but you got to be careful. Over leveraging, taking on too much debt, it can really backfire.
I can see how that could happen. Like you get excited about a property.
Right. And the numbers look good, so you want to leverage as much as possible to maximize your return.
Exactly. But then what? Like, what are the downsides of overdoing it?
Well, think about it. What if your rental income drops? Maybe a vacancy, unexpected repairs, something like that.
Oh,
Yeah, if you're already stretched thin with mortgage payments, even a little dip in income could be a problem.
it's like a balancing act, right? You want to push it, but not too far.
Exactly. That's a great way to put it. One really important thing is aiming for positive cash flow. So that means even after your mortgage payments, taxes, insurance, all that stuff, you're still making money.
So before even looking at loans, you really got to analyze the property's numbers.
Absolutely. And don't just think about the ideal scenario. Factor in potential problems.
Like, what if the roof needs replacing?
Exactly. A broken appliance, legal fees, those things happen. If you're not prepared, those costs can really throw you off.
And that's where cash reserves come in, right?
Yes. Having that extra money set aside can be a lifesaver. It gives you that cushion so you can handle those unexpected things without, like, panicking.
Peace of mind. Okay, so let's say you've run the numbers, you've got your cash reserves, and you're ready to start looking at loans. What do you do?
Don't jump on the first offer you see. Shop around, talk to different banks, credit unions, even look online. Compare interest rates, the loan terms, everything.
Because it could really make a difference in the long run.
Huge difference, thousands of dollars over the life of the loan. And while we're talking about getting the best deals, another smart move is building relationships.
Like with lenders and real estate agents.
Yeah. Networking is so important. A good agent can find properties that fit your goals, and a lender who knows you, trusts you, might be more willing to work with you.
So it's more than just rates and numbers. It's about the people, too.
Exactly. And when it comes to building a portfolio, diversification is key.
Wait, diversification with loans.
Yeah. Don't limit yourself to just conventional loans. Explore different options like seller financing, maybe a portfolio loan later on.
So it's about having a toolbox, using the right tool for the job.
Yes. The more options you have, the more flexibility you have to make smart decisions.
This is great. But let's be real. What are some common mistakes people make? What should people watch out for?
One of the biggest ones is underestimating costs. People get so focused on the mortgage payment, but there's so much more.
Taxes, insurance, repairs, like you said.
Right.
Yeah.
And don't forget those upfront costs, too. Closing costs, inspections. Maybe you need to do some work on the property before renting it out.
So budget realistically. Don't get caught off guard.
Absolutely. And this is where I go back to cash reserves. It's so tempting to think you can just use rental income for everything.
But what if something happens and the property is vacant for a while?
Exactly. Or a major repair that's way more expensive than you planned. Cash reserves can really be a lifesaver in those situations.
It's like a safety net for your investment. Okay, what else should people be careful about?
Loan terms. Read everything carefully. Don't just sign without understanding interest rates, repayment terms, prepayment penalties, all of that.
Those loan documents can be pretty intimidating.
They can. But knowledge is power. Ask questions. Do your research. It's worth it to make sure you really understand what you're getting into.
So be an informed borrower.
Yes. And don't be afraid to negotiate. Lenders are often willing to work with you, especially if you have a good plan and a good track record.
Okay, I'm feeling a lot more confident about this now.
Good. It can feel overwhelming, but it's really manageable if you take it step by step.
Definitely. And it's exciting. There are so many possibilities.
It is. And we're going to talk about how to actually find those opportunities and make them work for you in the next part.
Okay, so we've learned about all these different financing strategies. Now, for our listener out there ready to get started, what should they do? Where's the starting point?
Well, that's the question, isn't it? And like most things in real estate, the answer is it depends.
Yeah, I figured there wasn't going to be a simple answer.
Right, but that's what makes it so interesting. There's no one-size-fits-all solution. You have to figure out what works best for you.
So it's really personalized.
Totally. First thing is really think about your goals. What are you trying to achieve with real estate?
Like, what's your vision?
Exactly. Long-term growth, quick cash flow. Do you want to build a huge portfolio or just a few really solid properties?
So it's not just about getting the lowest rate or the biggest loan.
Nope. It's about finding the financing that fits your overall plan.
Okay, so define your goals. What's next?
Then look at your finances. How much cash do you have? Debt to income ratio? How much risk are you comfortable with?
Because some of these loans are riskier than others, right?
Absolutely. Like that hard money loan, it's great for flipping, but not for a long-term hold.
So you got to choose carefully.
Yes. And that's where research comes in. Talk to people, lenders, agents, other investors, see what's out there, what might work for you.
But don't forget those creative options we talked about.
Right. Seller financing, lease options. Sometimes those can be the best deal.
You're thinking outside the box.
Exactly. Building relationships, negotiating. Sometimes it's about finding a win-win for everyone.
Okay, so know your goals, know your finances, do your research. Anything else?
Keep learning. The market changes all the time. New options pop up. Don't be afraid to ask questions.
Stay curious.
Yes. So much to learn in real estate.
This has been an awesome deep dive. I feel like I've learned so much.
Me too. We covered a lot of ground.
We did. As we finish up, I have one question for our listener. What financing strategy is going to help you reach your real estate goals?
It's a good question. Think about everything we talked about. Your goals, your resources, how much risk you're comfortable with. And then go explore. There are so many possibilities out there. The right financing can really make a difference.
Well said. Thanks for joining us on the deep dive. We'll catch you next time for another fascinating exploration.